You ever wonder how the pros can just look at a massive commercial building and almost instantly get a feel for its financial health? Well, it turns out they often start with just one single number, a kind of secret number that tells them almost everything they need to know. And today, we're going to pull back the curtain and show you exactly what it is. So picture this. You're standing in front of this massive, gleaming skyscraper. It looks incredible, right? But is it actually a good investment? Is that building a cash-flowing machine, or is it secretly a house of cards, just waiting to collapse? How would you even know? For the people who really know what they're doing, the answer often lies in a simple four-letter acronym: WALT. Now, this isn't just some boring industry jargon. It's literally the key that unlocks the financial stability of a commercial property. So WALT stands for Weighted Average Lease Term. The easiest way to think about it is like taking the building's financial pulse. It tells you the average time left on all the tenant leases. But, and this is the really important part, it gives more weight, more importance to the tenants who are paying the most rent. Okay, so how do we actually find this magic number? It's actually a lot more straightforward than you might think. Let's just walk through a quick and easy example together. All right, let's pretend this is our building. We've got 3 tenants. Tenant A is a solid business. They've got 5 years left on their lease. Then we've got tenant B. This is our big anchor tenant paying the most rent, and they are locked in for a solid 10 years. And finally, there's tenant C, a smaller shop with just 3 years to go. Now, the formula itself looks a little intense, but it's actually really smart. All you do is multiply each tenant's remaining lease term by their annual rent. Then you add all those up and you divide the whole thing by the building's total rent. This way, the tenants who are paying more have a much bigger impact on the final number, which is exactly what we want, right? So, let's just plug in our numbers. We take tenant A's 5 years and multiply it by their $100,000 rent. Then we add tenant B's 10 years times their $200,000, and finally we add tenant C's 3 years times their $50,000. And we know the total rent for the whole building is $350,000. And when you run that calculation, boom, you get 7.6 years. That is our building's WALT. This one number gives you this amazing snapshot of the building's income security for the next, well, 7.5 years. Okay, great. So we have a number, 7.6. But why does it matter so much? I mean, so what? Well, this is where WALT goes from being just a simple calculation to an incredibly powerful tool for understanding a building's stability, its value, and its risk. Think about it. A longer WALT means you have a more predictable stream of cash coming in for a longer period of time. And that kind of stability is like music to an investor's ears, and to a bank's ears for that matter. It directly impacts the building's price, it affects what kind of loan you can get, and it tells you exactly how soon you're going to have to worry about finding new tenants. This quote just nails it, doesn't it? In the world of these huge multi-million-dollar investments, certainty is basically gold. A long WALT is like a promise of less risk in the near future, and that kind of peace of mind is incredibly valuable. So here's the bottom line, the crucial point. You could have 2 identical buildings side by side, but they could have wildly different price tags. Why? Simply because one has a WALT of 8 years and the other has a WALT of 3. That higher WALT signals safety. And that means a higher valuation and banks that are much, much happier to lend you money on better terms. But, like any single number, WALT doesn't tell you the whole story. You have to know how to read the fine print, or you could get a totally false sense of security. This is a big one. You always have to ask, is this the WALT to expiry or the WALT to break? The expiry version is optimistic. It assumes everybody is going to stay until the very last day of their lease. But WALT to break is way more conservative. It calculates the average based on the earliest possible date a tenant can legally get out of their lease. A really sharp analyst is always going to look at both. And yeah, there are a few other little traps. WALT calculations usually just ignore empty space. So a building that's half empty can still have a great-looking WALT on paper. And you gotta remember, a 10-year lease with a shaky company that might go bankrupt isn't nearly as good as a 5-year lease with a huge, stable blue-chip company. The quality of your tenant is just as important as the length of their stay. So what does a good WALT even look like anyway? Well, that totally depends on the type of property you're looking at. Let's see how this actually plays out in the real world. And you can really see how this works across different property types. For a standard office building with lots of different tenants, a WALT between 4 and 7 years is pretty normal. But for a big industrial warehouse, you'd probably expect something longer, maybe in the 5 to 10 year range. And then you have what are called net lease properties. Think single-tenant buildings like a CVS or a McDonald's, where WALTs of 10, 15, or even 20-plus years are pretty common. And this is exactly why investors look at these properties so differently. That super long WALT on a net lease building signals a very stable, almost bond-like investment. On the other hand, the shorter WALT on an office building tells you there's a lot more active management and therefore a lot more risk involved. All right, so for our last section, let's look at how different investors actually use this number to build their strategy. Because believe it or not, a good WAT isn't the same for everybody. You've basically got two different types of investors. The core investor, they just want stable, predictable returns. For them, a long WALT of 7 years or more is absolutely perfect. They want to buy it and hold it. But then you have the value-add investor. They see things completely differently. They might actually hunt for buildings with a short WALT because they see it as an opportunity to get rid of old tenants, renovate the space, and sign brand new leases at much higher rents. See, one person's risk is another person's opportunity. But no matter what your strategy is, there are some universal red flags to look out for. A WALT under 3 years, that signals immediate intense pressure to find new tenants. If a huge chunk of your income, let's say over 30%, is all expiring in the exact same year, that is a massive risk. And if you see a big gap between the WALT to break and the WALT to expiry, that tells you that your supposedly stable rent could evaporate way sooner than you think. So at the end of the day, WALT is an incredibly powerful number. It's fantastic for measuring the certainty and stability of a building's income. But it doesn't tell you anything about the quality of that income. Which leaves us with a final question to chew on, which is the better bet, a 10-year lease with a brand new startup or a 3-year lease with a giant like Google? The answer to that question really defines your entire investment strategy.